Presentation of dialogue on Idaho Public Television is made possible through the generous support of the Laura Moore Cunningham Foundation, committed to fulfilling the Moore family's legacy of building the great state of Idaho.
Coming up, she's had to make sense of America's financial crisis for readers all over the world. A conversation with Pulitzer Prize-winning New York Times reporter Gretchen Morgenson. That's next on Dialogue. Hello and welcome to Dialogue. I'm Marcia Franklin. Credit default swaps, derivatives, AIG, Fannie Mae, and Freddie Mac. For the past 2 years, Americans have added new words to their vocabulary and new debt to their children's balance sheets as our country bails out company after company. And since the beginning of this crisis, New York Times reporter Gretchen Morgenson has been trying to translate its complexities for readers all over the world. Morgenson has worked at the New York Times since 1998 and is both an assistant business and financial editor and a columnist there. In 2002, she won a Pulitzer Prize for her coverage of Wall Street. I caught up with Ms. Morgenson at the Sun Valley Writers Conference. Since 1995, the conference has been bringing together prize-winning, insightful authors to share their works and their ideas. I started by asking Morgenson to talk more about what she sees as the underpinning of the crisis, the push by the federal government to increase home ownership. First of all, thanks for taking time to be here. I understand this is your first time in Idaho.
Definitely. It's beautiful. Happy to be here.
You know, I want to start right in and talk about what you see as one of the main causes of the financial situation we're in right now, and that would be the push by our government to increase home ownership, which started in the Clinton era with the National Home Ownership Strategy. Why do you think that was the underpinning?
Well, because this strategy, which, as you said, was launched in 1995 by Bill Clinton, was designed to be a public-private partnership. That meant that the government was going to be involved and the private sector was going to be involved, and the goal was to increase home ownership. I think home ownership was about 64% at that time and had been falling in the early 90s, and so there was this push, you know, that the belief, there was this really kind of a consistent belief that home ownership was good for society, that the more people that owned their homes, the more stable neighborhoods would be, the better grades kids would get in these homes. It was, you know, just a really sort of mom and apple pie theory, you know, that home ownership was a greater good for everyone. And it's a noble idea, and as many government programs are, you know, a noble idea, but taken a little bit astray. Because at the same time that you had this kind of push for home ownership, you had a regulatory retrenchment. You had the regulators being unwilling to watch over the private sector in the housing industry, the banking business, the Wall Street brokerage firms that were financing so many mortgages, the home builders, the appraisers, all of those, you know, ancillary and very, you know, key players to the mortgage and home building boom really were kind of left to their own devices. And so while it was a good idea and a good noble cause, it really kind of went off the rails.
Now, there were people that were sounding alarm bells, who were saying, wait a minute, there's some scurrilous stuff going on out there. There's people signing papers that they don't understand, and they're going to be making these huge balloon payments. And so there were some people out there. I'm wondering, who are some of the people that you think were trying to let us know that something was going wrong?
You know, one of the groups that I think was really onto this very early was consumer lawyers who, you know, pro bono consumer lawyers who work with low-income people, middle-income people who are not necessarily attuned to the kinds of games that the financial Sharpies can play. And so these people saw a lot of the kind of problematic loans as they were ramping up in 2004, 2005, and they started to sort of, you know, try to raise alarm bells and in some cases actually got somewhere with some state legislators to try to rein these lending practices in. And so there was a wonderful case of a predatory lending law in Georgia that was put forward in late 2003 and early 2004, which would really have been very helpful for borrowers to protect them against these kinds of high-cost loans that we saw so many of in the subprime area. But what happened was that the major, some of the major players, the financiers, and the rating agencies
Moody's.
Stepped in. Standard & Poor's actually announced that they would no longer rate mortgage securities that contained loans made in Georgia if this predatory lending law was passed. Well, of course, that put the complete kibosh on it. Everybody understood that if S&P wasn't going to rate these loans, that they wouldn't be able to be sold, that the money would dry up for the loans, and so the bill was watered down as a result.
So it's probably fair to say we know why the private sector kept going with this, because there's big money to be had in it. Why were the regulators asleep at the switch? What possible reason would they have for turning a blind eye?
Well, I think perhaps initially they were ideologically predisposed to the idea of home ownership. You know, here you have the President of the United States, and by the way, George W. Bush was also in the same camp. It's not a Democrat or Republican thing. It's actually across the board. And so here you have the, top guy in the nation saying, we want to encourage home ownership. And so that sends a message down among other regulators. But I do think that it was also partially an idea that it coincided with a notion that regulation was onerous, that regulation was stymieing innovation, and that regulation was bad.
Well, now we're in the fix that we're in, and there's talk of more regulation. Can we trust the regulators who look the other way before? Do you think that there is some good regulation that can be had out there, and we can not worry?
Well, I think what we really did not have was regulators with an appetite to regulate. I'm not advocating more regulation. I think there is a lot of regulation now. We just need people in there who understand that their job is important, that it's crucial to protecting consumers, borrowers, the entire system, as we saw. Had the regulators done their job, we wouldn't have this systemic risk that has really punished every taxpayer in America. So I think that we just need people in these posts that have a fervor for their jobs.
Well, do we?
And unfortunately, some of the people that we have in these top levels of government were really kind of on the scene when, this crime was unfolding. And so, should the Federal Reserve, which believes it should be the most powerful regulator of financial services companies in this country and should in fact get more power, should the Federal Reserve, who really fell down on the job, get more power? That seems to me to be kind of the wrong response to a regulatory failure. There were many who believed that the regulators who were in place during this period were captured by their industry, by the people that they were supposed to regulate. They were socializing with them. They were very close to them. They almost had the mindset of the industry, that dominated their view, their worldview. And so, I think that we do have to, ask the question about whether these are people who are able now to really turn around and say, we really need to have a very kind of vigorous regulatory system to protect people.
I'm sure you get this question a lot. What about the responsibility of the individual homeowner, the one who knew how much they were making and either just thought they could pull together the money or frankly lied on their forms? Because what about, doesn't some of the responsibility lie with somebody who took on more than they could?
Yes, absolutely. I mean, there's plenty of blame to go around, and the borrowers who lied on their mortgage applications are certainly a part of this problem, a very big part of this problem. But it's very hard for me to delineate between those people who lied and the mortgage brokers who may have changed the documents after the people signed them. I know there was a lot of that went on. I also feel that the people who lied on their mortgages and who are now in foreclosure are in fact paying a price. Their credit is wrecked. They have to move out of their home. They have to maybe rent. I mean, it's a very awful thing to go through. And so I have a little bit of sympathy for them because they are being held accountable in a way for their misdeeds, as it were. Whereas these bankers who made these bad loans and made these bad decisions, many of them just waltzed off the scene with hundreds of millions of dollars and are not being asked to pay the price.
Do you see a corporate executive that you hold up as a good example right now during these times?
A corporate executive?
Or the head of a financial firm, or head of a bank?
There must be somebody, right?
There must be somebody. Anybody who you feel is taking responsibility, doing things correctly. A model, basically.
Yeah. I'm sorry, I can't come up with anyone at the moment. That doesn't mean they don't exist. It's just that I'm coming up with a blank.
So there's nobody on the level of like Sheila Bair on the private sector side that you think is stepping up to the plate and saying, hey, you know, we need to, whether it's the head of Bank of America or JP Morgan or any of these companies, you don't see kind of a shining light there. It's interesting to me that nobody like immediately comes to mind that's leading the charge on the private side.
No, I think in fact what we've seen is a kind of a, back to business as usual. I think there's a sense that, now the ugliness is over, the really, really dangerous period has passed. And so let's, go back to our old way of doing things. And I find that to be a little bit dispiriting, disappointing, because, the taxpayer still owes, and is still on the hook for these things. And what I had hoped I would see would be a kind of a big mea culpa and a big, sense that, look, we really learned our lessons this time. And, the thing that I'm constantly mystified by is, you can make so much money as an honest banker, as an honest brokerage firm. You can make so much money if you treat your customers well. I do not understand why people take the risk that's involved with, doing the wrong thing and instead of doing the ethical thing.
People seem to want to hold some of those individuals accountable. Do you think that will happen?
Well, it's hard to predict that. These are hard cases to make. It's not just about, saying what you did was wrong. You have to prove it. You have to prove that a securities law violation occurred or a fraud occurred. And so, those are cases that take an awfully long time to make. So it's very hard for me to predict. I do think that if there aren't, a considerable number of such cases, that people will feel that the game is rigged against them.
Now, we should say you write both what we call straight journalism, or your bylines on hard news, and then you also have a column. And some have pointed to that and said, oh, that's a conflict of interest, that she's giving her opinion at the same time. How are you able to straddle both?
Well, I think my columns are certainly not the kinds of columns that are just sort of opinion where, I'm gazing at my navel and talking about what I see. These are what I would consider to be very heavily reported columns. So not so much opinion as really trying to marshal a case, marshal my facts, and drawing the reader into that array of facts. I'm not saying I don't take a stand, because I do, but it really is more about letting the facts that I report on, that I put forth, tell the reader sort of what is going on.
And one of the things that you've written quite extensively about in your columns is executive compensation. And people just, this is certainly one thing that resonates with people. They can't understand, after all the taxpayer money that goes into helping these companies, and people are still walking away with, $700,000 bonuses or whatever. How is this continuing to happen?
Well, there are a number of arguments, which I don't agree with, but one is that if we don't pay people what they are worth in the market, that they will go next door to my competitor. that you know, CEOs have a level of compensation that is, you know, absolutely required for the job, and their peers earn X, and so they should earn X. You know, there are all these arguments. Well, my feeling is that the actual rate of growth in executive comp has so far exceeded you know, the growth in the stock market, you know, any really other measure that kind of growth in earnings at these companies. And so it's really become kind of untethered to reality.
How can it continue to happen, though? I mean, with public money involved in these companies, can't they just say you can't do this?
Well, it's unfortunately the role of the directors to rein in executive compensation. And as you know, directors are often very friendly and palsy with this chief executive officer or the chairman. And it's a dysfunctional relationship still, even to this day, even after Enron, WorldCom, Tyco, Adelphia, even after all of these really, you know, upsetting corporate crimes, the board of directors are still sort of confused, don't seem to understand that their task is to represent the investor who owns the shares in the company, not to give the CEO what he wants in the way of compensation or perquisites. Until investors can have a way to fire directors because they're not doing their job, then we're going to continue to have this kind of dysfunctional relationship. We, of course, as you know, investors cannot fire directors, that they can only put up an alternate slate for a board seat. And this is very difficult, expensive, oftentimes hard to win. So until we have a truly democratic situation in the boardroom for elections, then I think we're just going to continue to see this kind of dysfunction.
And would that take legislation to change that? Or?
Well, the SEC is trying to make that happen at the moment, but it's so you know, entrenched, the system that we have now, that it's going to take a very long time to make any kind of movement on that.
You know, I think people's eyes glaze over now when we think about how much public money has gone into, you know, bailing out companies, into the TARP program. You know, I remember doing a program on this, and one of my panelists said, well, actually, you know, the taxpayer's getting these things for a really cheap price, and eventually the taxpayer, meaning the government, is going to make some money off of this. It'll be a good thing. Do you think the taxpayer is ever going to see a return on all this money that we've pumped in?
It's going to be very, that answer is going to be long in coming. I mean, the healthy banks have paid back their money they received under the TARP, and in those cases they paid it back with interest, which was good. So there's a little bit of an interest, you know, a little bit of a gain there. But we have a tremendous number of very big institutions that have taken a lot of money and who, you know, are still in fairly bad shape. And so therefore, those are sort of the big, you know, users of the capital. And so to the degree that the smaller guys have paid it back, that's nice, but that's not really going to outweigh what these big institutions. AIG at the moment has a taxpayer commitment of $173 billion. Now I think that's going to, when all is said and done, going to be the single worst you know, bailout, the single biggest money pit for the taxpayers. I could be wrong, but I think that that's going to be the very biggest one.
Is anyone watching where all this money is going?
Yes, there is actually a pretty aggressive and smart Inspector General who is in charge with watching the TARP. He's called the Special Inspector General over TARP, and he's a take no prisoners guy, which is good for the taxpayer, and he calls them like he sees them. So that's good. But, you know, there are other investments that the Fed has made, the Bear Stearns bailout, of course, you know, which was $29 billion in assets that J.P. Morgan Chase did not want to take on when the marriage between those two companies took place. That obviously has declined in value, so those are we're registering losses there. So, you know, it's all over the place, but it's far too soon to say that we're really going to make money on this.
At the same time, we've got people who are trying to modify their loans so they can stay in their homes. And prior to this interview, I had a woman come up to me on the street and say, you know, she knew I was a reporter. I didn't know her. And she said, you know, so many of my friends are upside down on their mortgages and they're trying to work out loan modifications and nothing's happening and they're going to have to foreclose. And you've written, I thought some of your most interesting articles recently have been about this issue of how long it's taking to do loan modifications and short sales and how much more money the banks are losing on foreclosures.
Right.
So what's the logic there? You know, why won't, if they're losing more on the foreclosures, why won't they modify the loans? It's money, it comes down to money, yeah.
There are a couple of answers, and it's very complicated, but I'll try to summarize them. First of all, the first fly in the ointment is that these mortgages, many of them, are in big pools of mortgages, mortgage securitizations that were put together by Wall Street and sold, sliced and diced and sold to various institutions who wanted varying degrees of risk. Many of these loans are in these pools, and that makes it very complicated to find out who owns the loan. So if you need to modify your loan, you need to know who to talk to on the other side of the table to say, hi, I'm having trouble. Please help me. I need to get out of this loan. I can pay this, but I can't pay that. You know, the normal relationship you would have with a banker, where you would go into the banker and say, oh my gosh, Sam, you know, I said I could pay you back, but I'm having difficulty. I lost my job. I had a medical emergency, whatever it is, and yet you can't, you know.
It's funny you mentioned the name Sam because my grandfather, Sam, was a small town banker.
There you go.
On the border of West Virginia and Pennsylvania.
Okay.
And he knew everybody he loaned the money to.
Okay. Those days are over, all right. So here you have a faceless, nameless person who owns your loan. You can't deal with them. You can't find them. The entity that is supposedly serving that person doesn't want to modify the loan because that goes against what they are obligated to do. It's very complicated. Okay, so that's first. Second of all is that there are a lot of fees generated in a foreclosure, in a delinquency, that go to the servicing companies. And I am sorry to say that I think that is a real motivator. They have constant appraisals, they have legal fees, they have this fee, they have that fee. I mean, it is, if you were to look at a statement that a lender gives to a person who's in foreclosure, you would see just incredible fees there. And this money comes out of these people's hides.
That's why some people trash their homes before they leave because they're so frustrated with the whole process.
So those are two answers to why it's just not being done.
And even if you do get a loan modification, you should scrutinize that very carefully for those type of fees within the...
They throw them right in there. They throw them right in there, and you're getting even further behind the 8 ball.
We don't have much time, but Fannie and Freddie, this is another thing you've written extensively about, and the taxpayers' involvement now with these huge entities. Do you also feel like AIG that this is a big sinkhole, or will the taxpayer realize any benefit from?
Fannie and Freddie, you know, it's going to be hard to tell. To the degree that they made, you know, less risky loans, you know, it will not be as damaging. You know, AIG was just a situation where now the company is really trying to sell off assets and in a very difficult environment to do so. And so it's just hard to see how they're going to really be able to come up with the kind of money that they need. Fannie and Freddie, you know, you do have mortgages underlying the, you know, the assets there. So we just hope that it doesn't get much worse in, you know, the housing industry.
Do you think it'll turn around?
They can maybe climb their way back. Well, the difficulty is, of course, that there's no lending going on. And, you know, banks are hoarding their capital or, you know, having to raise more capital and shore up their balance sheets. And until they can feel that they have the capital they need to cover the losses that are inevitable, that have not yet been recognized, they're not going to be able to make loans. And so that alone, and loans to commercial businesses, to individuals for homes, all that makes the world go round. And so that's what we really need to see starting again before the economy will start to turn.
How do you get your sources for these complex investigative stories?
Well, working for the New York Times makes it a little bit easier because, you know, after people recognize what kinds of stories you do as a reporter, you know, then they, of like mind, will come to you with story ideas. And I do get quite a few over the transom. But I also have over the years, I've been at the paper for 10 years, and before that I was at Forbes for many years. I do have a lot of sources that I've built up over the years who I trust and who trust me. And I was on Wall Street for a while, so I understand the way the business works and where the bodies are buried. So it's kind of a combination. of sources.
You've said that the story's now moving to Washington, D.C., which makes it harder for you to report it. Ironically, you'd think, okay, seat of government, more openness, Wall Street, more closed records. But actually, the filings, you say, when you cover Wall Street are more open, and there's less transparency in D.C., which I find fascinating.
Isn't that interesting? Yeah. I'm not a Washington reporter, and I'm happy I'm not. Wall Street, covering business is a lot easier because there is so much in the public domain. There are so many filings that are filed with the SEC that you can really tell the whole story about a company because it's their financial situation, their financial soundness. You know, now that we are moving to Washington, we have to rely on Freedom of Information Act requests. We have to rely on governments, the government to come forward with documents that we want. It's really like pulling teeth. We have had a dickens of a time getting documents out of the Treasury, even getting answers from the Treasury about how many loan modifications have been done under their new program, which they launched several months ago. And so, you know, the government likes to say that it's transparent and open, but it really isn't. I'm just not finding it to be the case at all. So it makes the story that much more difficult to pursue, unfortunately.
And you've been critical of some of the journalists who report in that arena, saying that it's access journalism, that they really have to get kind of cozy with the people, their sources, which is anathema to you.
It's not that I'm critical of them, it's just that's the game in Washington. And, you know, I sort of feel like to play the game, you have to have that, you know, access to high-level officials, and they leak things to you. And I'll tell you, I would not be very happy if I had to sit around and wait for some high official to leak me a document, because then I would be beholden to that person. And, you know, I just don't like being in that circumstance. I like being in a position where what I am writing about is backed up by public documents and/or documents that I can verify are, you know, real and accurate. I don't want to have to worry about serving people in high places who've helped me out. I'm really for trying to, you know, educate my readers, shine the light on the dark corners so that they can understand where their money is going and what's gone on.
Well, thank you very much for, in this short period of time, shining a light on the issue. I appreciate you taking the time.
Thanks for offering. I really enjoyed it.
You've been listening to Gretchen Morgenson, a Pulitzer Prize-winning financial journalist for the New York Times. And Ms. Morgenson says when she gets some time, she's going to write a book about her experiences covering the financial crisis. I spoke with her at the Sun Valley Writers Conference, thanks to the organizers of that event. If you missed any of this dialogue or want to watch it again, go to our website. We're also on YouTube, Facebook, and Twitter. Check it out. For Dialogue, I'm Marcia Franklin.
Presentation of Dialogue on Idaho Public Television is made possible through the generous support of the Laura Moore Cunningham Foundation, committed to fulfilling the Moore family's legacy of building the great state of Idaho. To order a copy of this program from Idaho Public Television, call our toll-free number or visit us on the World Wide Web.